If you don't have this in an RRSP, you're going to pay tax on that this year. Derek here, back with another Financial Fundie. This time I would like to talk about stocks and bonds. Again, just the basics. I'm not an investment expert, but I just want to help everyone understand how exactly they work. So I think most people know that the way stocks work is that when you buy a stock or a share, you have a partial ownership in the company. Now, stocks make you money when the value of the stock goes up. So if you own a number of stocks and the value per share goes up, you have what's called growth. And now, as I mentioned in the previous video, if you don't have this in an RRSP, you're going to pay tax on that this year. So if your Apple stock grows in value, you're going to pay income tax on that. Now, there's a second way that stocks pay, of course, and that is in dividends. So many blue chip companies, and by blue chip, what I mean is well-established companies that historically continually produce positive results, income, and they're a growing company, stable companies, normally will pay dividends. So there's two ways stocks pay. Now bonds. Bonds are different. They're not an asset. They're not ownership. Bonds are debt, typically in the form of a certificate. So many people are familiar with things like Canada savings bonds. Maybe your parents bought them for you when you were a kid. And they had a face value, let's say, again, for simplicity, $1,000. And let's say the maturity was a year from now, and it was a 5% bond, so it matures at $1,050. So that is not growth, that's actually interest paid on that debt instrument. Now, one important thing to know in your own portfolio is that when stock prices go up or stock portfolios do well, bond prices tend to go down because you can do better if you invest in the stocks than you might do by owning this bond that has a guaranteed 5% return, for example. Normally have an inverse relationship. So in a growing, thriving market, you probably want to have your investments somewhere in stocks or a stock portfolio or a growth portfolio. And in a downturn economy, it is probably prudent to have them in a bond portfolio. So that's it. I hope that makes sense and simplifies stocks versus bonds. One is ownership, one is debt, one pays in growth or dividends, and the other one pays in interest at maturity. So that is your Financial Fundie.